Good morning, everybody. This is Bob Burton of Provada Insurance Services, and we're delighted today to present you with an absolutely wonderful webinar conducted by our good friend Bill Upson, CLU CHFC, one of our great producers. We should be very fortunate, we are very fortunate today to have Bill making this presentation. He is a 10-time consecutive top of the table member, a great guy, and does absolutely wonderful work across the board. And I don't want to take up a lot of time to introducing him, and I'm sure he'd just like to get right into the meat of this. The subject today is opening the door to larger opportunities, and he will be discussing how he uses long-term care as kind of an introduction to open those doors. So Bill, you're on.
Thank you so much, Bob. By way of introduction, I'd like to ask you a question as an audience out there. In the last year, have you sold a long-term care policy? And you can check off yes or no on your computer screen and just submit that. We'd like to get an idea from what we're actually seeing in the way of opportunity to help you better understand this issue. Why discuss this subject? The entire reason for discussing this subject is that it opens the door to larger opportunities, and in the grander scheme of things, it will reduce your liability if it's handled properly. I'd like to give you several different stories that should bring your attention to this, and in the sense that it is something that is out there in the marketplace and many people do not know about it. This first slide goes back to an article in the Journal of Financial Planning, August 2005, by Harley Gordon. He's an attorney out of Boston and wrote this article to try and advise people in our industry to be very, very careful about this issue, because we do hold ourselves out as financial advisors, as insurance agents, and we do take the risk by not bringing up this subject that we open the door to future claims and litigation, and I think it's very important that you at least know about that. Also, Saturday, April 1st, 2006, there was another article, and this came from Registered Representative, and it's called Scary Story. And this is a true story about a representative in Utah who inadvertently had thrown away all of the information he had allegedly provided to his clients 15 years prior when confronted by the client's son and the client's son's attorney. And he settled for over $600,000 of personal money, in addition to legal fees that he had to pay because his errors and omissions insurance coverage did not take care of this issue. Because he had committed fraud by holding himself out as an insurance agent, the litigation eventually got settled in this manner. There have been several other situations, and I just want to bring it to your attention so you know about it. When you start to think about this type of opportunity, you have to think in terms of multi-generational planning and also business sales, which we'll get into later in this discussion. And as I said just a moment ago, ethically, you really are required to do so. You are an advisor, so it's extremely important that you understand that. How we do it. What we basically do is to provide a financial plan to our clients, and what we try to do is to save them on taxes before something comes up and they are all of a sudden in a situation where they're suffering substantial losses. The financial plans we do are really driven by looking at their tax returns. We also get involved in making sure their property and casualty is reviewed, their income and estate tax is reviewed, insurance and investments, the titling of assets, everything that has to do with properly setting up a plan that covers these kinds of issues, and in some cases may cover 2 to 3 generations. If we're not doing a financial plan for a client, we truly are not interested in developing a relationship, because a transaction doesn't do anything to meet that client's future, even current needs, and we feel that we're doing something that is counterproductive to what they're truly coming to see us about. In the process of doing the property and casualty review, I will tell you that we send that out to casualty brokers. I use AIG because it's part of the network I'm in, but you can use brokers of your choice. And you will find that when you start sending business to casualty brokers, much like CPAs and attorneys, from time to time, all of a sudden they'll send you something back. We don't do it for that reason. We just pick the best broker we can find to make sure the client has the kind of coverage they need.
Bill, you showed me your financial plan, one of the financial plans today, and I just want to mention that it is really a comprehensive plan, which is largely what enables him to get into all of these other areas. I found it very exciting.
Thank you, Bob. It's done by Money Guide Pro, and I'm sure you have other software products available to you, but it works well for us because it is web-based. We can share it between the different representatives as well as the clients and their advisors, so it works very well for us. You'll notice on this next slide that I have VIS listed here. We're going to talk about this later, but it's called Video Inventory Services, and we offer this as part of the financial plan. It does open the door to other referrals, and what we do is to videotape the client's homes and put it on permanent record. Moving on, if the plan does not improve their financial position, we do not charge for it. But by looking at the tax return, having the CPAs we work with and the attorneys we work with review it, we can normally find that there are tax savings on the return available immediately, and then we can charge appropriate to what we feel the time and effort will require. We bring in specialists in the area of legal work, of course CPAs, family office planning where it's appropriate, the property and casualty, and we also bring in sources that are not offered in-house but may be provided by networking. In some cases, when you start to get into office planning, family office planning, you're also really talking about a lot of the family emotional issues that go on generation after generation. So we bring in specialists in that area also. Now let's move into the book, and let's talk about the use of the book in terms of what you're trying to achieve with your clients, and the reason the book, I think, can be a very powerful resource for you.
Bill, just remind them which book you're talking about. It's Bill Upson's book on long-term care.
This is the book Long-Term Care, Alternatives and Solutions, and it was originally written 7 years ago and has been updated 3 times. The most recent was the spring of 2007. And in the most recent edition, we have added 2 chapters, which we will get into here in a few moments, but the first one is called Insuring Your IRA Account. And that was written up in the July and also, I believe, the January editions of the MDRT Round the Table magazine as ideas that people normally don't hear about out there, and we'll discuss that in a moment. The other chapter is on IRA distribution planning, so it goes way beyond just dealing with long-term care issues. Let's take a look at the pages that we're talking about here, and you'll notice on this slide that you have in front of you right now there is an orange sheet called a waiver. We'll discuss that a little further on also. And lastly, I want to point out to you that I'm not trying to replace you by giving out copies of the books potentially to your clients. I'm trying to position you as an expert locally so that they will see that you're bringing to the table all of the information they need to make an adequate decision. We do also provide discounts for quantity purchases, so that just so you know, if you wanted to buy these and hand them out to 10, 15, 20 clients at a time, you could do so. And you can call us directly or go to our website, but the 800 number is 765-0561 extension 143. If you go to the website, as you can see on your screen, it is longtermcarebooks.com. It is still somewhat being completed out, but it will be available with a great deal of information within the next month to 2 months. We're there to answer questions, but we do it with the support of Provada. People like Bob Burton and Alan Silva have provided incredible information for us over the past few years. Let's talk about the pages, and I'm going to go through these fairly quickly just so you know where you can utilize this kind of information. This slide you see in front of you at the top says figure 15.2. The page number at the bottom left side indicates where it is in the book. It is page 135. This is simply a description, because we talk about world population trends in this chapter 15, of what's happening in the country of Japan. Back in 1950, the population was just a little shy of 84 million. As of the end of last year, it's been estimated that it topped out at just a little over 127 million people. The population will begin to decline because of declining birth rates, and by the year 2050, roughly, we're looking at a population of less than 100 million. As a consequence, if this trend continues by the time the year 2100 comes around, the population of Japan would be below 50 million people. So what does this mean? It means that all of a sudden there is an upside down workforce where very few workers are providing benefits for the many, and it obviously does not work. And we use Japan as an example because they have resisted and restricted migration into the islands. But this is a true story that really affects many countries around the world, and the United States is certainly affected by this situation too.
So the point, Bill, I gather, is that as the birth rate goes down and the population levels and begins to decrease, that more and more of the population are the older people.
Correct. There's no question about it. The next slide is on page 2 and 3. Again, just very quickly so you know, this shows the probability of a long-term care event for people 55 and older versus stay in a hospital, car accidents, or the loss of their homes. On the right side, you can see where the long-term care need is and where the coverage is coming from. And down below you can see the slide talks about what it does to people who are affected by caring for those who have those kind of needs. Page 16 talks about Medicare facts. This is the next slide. And this information is meant just to give you an overview of the kinds of things that are happening within Medicare to try and restrict the amount that is paid out for benefits. And you'll notice down near the bottom that people are being discharged much more quickly with much more serious illnesses and are winding up in nursing homes as a consequence at almost twice the rate they used to be. Next page talks about the issue of Medicaid or Medi-Cal planning here in California, and this one is on page 30. Don't want to spend time on this. Most of your clients would not be affected by it, but it's information you should know about and be able to provide to them. Next slide talks about the funding sources for long-term care, where it is currently coming from. Obviously, Medicaid and Medicare are going to become less and less available as they restrict these benefits. We're looking at a population explosion in the over 65 market from 35 million currently to over 75 million within the next 25 to 30 years. We're talking about an enormous strain on the entire medical system as well as the Social Security and Medicaid system. This figure 5.2 on page 36 is a very powerful one to show clients when they say to you they don't expect to spend any time in a nursing home. You can see just a few of the illnesses and the numbers of years that people on average spend in a nursing home or require home care. And I point to the bottom one, diabetes. This is a situation where it's increasing at an alarming rate in the United States and worldwide. And I would only anticipate that these numbers would go up, and so would the percentage of people going in for those. On page 37, figure 5.3, we're looking at 5% simple inflation versus 5% compound inflation. You'll see as you look down further on the screen that we've gone in 5-year increments so we could get it on one page. We're just trying to point out to you that you need to discuss this subject if you're going to talk about long-term care policies. And I know this is an issue that is of great concern with the folks at Provada, because they want to make sure that you're providing to the client not only the required coverages, but the client gets to see the obvious difference as they go out in time.
I think a couple of comments would be in order here. A number of our brokers have submitted long-term care cases or inquiries and seem to like to go into the 5% simple approach rather than the 5% compound. Well, if they can qualify for long-term care coverage today, the chances that they're needing care are not very great in the next several years. The chances of needing care will be 10 or 15 years down the line. And so if you look at the numbers, you can start with a lower benefit and put a 5% compound increase on it and see where the crossover point will be. And for every single year after that, the 5% compound will start to jump way, way ahead of the game. So certainly in designing plans, that is at least my personal preference, is if necessary to keep the premium manageable, start at a lower benefit and use 5% compound.
Right on the mark, Bob.